The Fed announcement's out and Rick Rule joins us this Wednesday. Rick, good to see you.
Always a pleasure, Daniela. Thank you for having me.
All right, Rick. Well, before we talk the Fed, let's talk about that recent announcement that made headlines. Sprott's recent hostile takeover bid for Central Trust, gold and silver funds that basically compete with Sprott's physical bullion trust.
You will note, being a Kitco employee, the demand for gold and silver haven't been particularly strong in the last 4 years. And yet, in these weak markets, Sprott has raised over $3 billion for its physical gold, silver, and platinum and palladium products. So clearly there is demand for these products. Further evidence of that would, of course, be our launching of the Sprott Gold Miners Index ETF last year, where despite launching in June, in a sector, gold mining, that wasn't popular in the market, we were the 9th most successful ETF product launch in the United States last year. So one would suggest that there is still substantial investment demand for precious metals. With regards to the strategy in terms of our announcement, for years we have existed side by side with the central fund product. Our product has always traded at a substantial premium to their product, and that's true for 3 reasons, which we hope to address with regards to this takeover. The first is that their product is not redeemable. In other words, theirs will always be a proxy for gold rather than representing gold or silver in someone's portfolio. Our instrument was meant to be a more convenient form of owning gold that had the ability to be converted into gold at the holder's election. That very convertibility meant that our products have always traded above or at or only slightly below par, where the central fund products have often traded at double-digit discounts to par, meaning that they were a gold-related investment instrument. But the variance between their price and the gold price meant that they were a very ineffective instrument for investors. The final reason why we made the bid, and by the way, we made the bid at the suggestion of central fund holders, was because it's increasingly important for North American investors to know something about the manager and sponsor of their investments. The Spicer family, who run Central Fund, are private and are understandably reluctant to release financial information about themselves. Sprott, by contrast, is public.
And Rick, we wish you luck with that, but I want to touch upon something important you said. You mentioned lackluster demand in gold. What do you think it would take to entice investors to get back into the gold space? Is it really just price-driven?
Simple math, Daniela. You know, the truth is, in every currency in the world except for the US dollar, gold has done its job for the last 12 to 14 months. We're in a gold bull market in most of the world's currencies. We aren't in a gold bull market against the world's hegemon, the US dollar. But I suspect that North American investors who are simply competent at arithmetic will come to the gold side. And let me make that case for you. The competing product I would suggest to you is the world's benchmark investment product, the US 10-year Treasury. And the US 10-year Treasury is increasingly less attractive relative to gold. The investment thesis behind the US 10-year Treasury is that the US government absolutely promises, and for once I believe them, to pay you 1.8% a year for 10 years. The problem with that promise is that their stated rate of inflation, the CPI rate, is 1.6%. So they're promising to pay you 20 basis points a year on your money. If you give them $100,000 in 10 years, they give you back $100,000. Well, Daniela, that's not much of a promise. I already have my money back. The problem gets worse, however, if you question the stated rate of inflation. And that's really what it gets to. The people who compile the CPI don't shop where I shop. And the truth is that, among other things, the CPI doesn't include tax. So their real promise is that I give them $10,000 and they give me back $9,600 or $9,500 in 10 years. Jim Grant calls that return-free risk. And the idea that the chief competition for gold is, on the face of it, so completely unpalatable tells me that gold will do well. The second point is related to the first. 6 or 7 years ago, if you and I went to buy gold, our cost was the foregone interest that we would have returned owning the 10-year savings. So if the US 10-year bond yielded us 6%, it would in effect cost us 6% to buy gold. That cost is much, much, much less. Does that mean that the gold market turns around next week or the week after? No. It takes a long time for the confidence that exists in the system to be replaced by the kind of skepticism that would be aroused by an understanding of addition and subtraction, not quantum physics. But I think gold will do well in US dollars just as it's doing well in other currencies over time.
And Rick, we're speaking right after the Fed announcement, and surprise, surprise, the Fed didn't give any clues as to when we could expect an interest rate hike. Why do you think they want to keep us on our toes?
I'm a lender, not a political analyst, and it's difficult for me to answer that question without descending into profanity or obscenity. I think putting the best possible spin on things, that they understand that markets hang on their every word. I believe you were in New Orleans at the New Orleans conference last October when Alan Greenspan spoke. And I think he set the standard for his Fed chairman when he said, if you understand what I just told you, I obviously misspoke. I think it is their job to run the economy as they see fit and as they need. And I don't think that clarity is among their goals. It's interesting to me that it would be, I think, fairly difficult for them to raise the interest rate. If they raise the interest rate, the implied delta between the yield on the 10-year Treasury and equity yields would decline, which would be hard on equity markets. It would also make it more difficult for federal, state, and local governments in the United States to service their debt. And while I'm not an economic commentator or a political commentator, I am a lender. And looking at the Fed's balance sheet, I would suggest that it's already stretched, even in a period of negative interest rates. So I wouldn't hold my breath for a rate hike.
Well, the reason I asked that question, Rick, it almost seems like it's this dark cloud hovering over gold as to whether or not the Fed will raise interest rates.
One of the advantages, and probably the only advantage of becoming as old as I am, is that you have seen situations similar to this many times in the past. If you will dial back to 2000, and don't tell me how old you were in 2000, it'll make me feel bad. But if you dial back to 2000, I had to write an article for my own clients called A Case for Gold, not The Case for Gold. The sentiment surrounding gold was so bad, and by the way, the circumstances were very similar to today. A strong US dollar, gold actually performing in other currencies, but not in US dollar. And the sentiment surrounding gold and the confidence in the US financial system right before the tech wreck was so strong that I had to write an article called A Case for Gold. There was total capitulation in gold equities in June and July of 2000, which set the stage for a recovery in the gold price from $252 an ounce to $1,900 an ounce. I am not suggesting that that recovery is imminent, but I am suggesting that that recovery is inevitable simply because of the arithmetic that we described earlier in this interview.
Well, Rick, you answered that really well, but obviously you speak very passionately about the gold market. You're obviously a believer in gold. So what would you need to see to happen in the gold market for you to ever really throw in the towel?
I suspect what will cause me ultimately to throw in the towel is that when the thesis of gold and silver and precious metals has been proven once again to be correct, and the gold price escalates to a point where it doesn't offer me up very much protection, or where the protection is so expensive relative to asset classes. In other words, when gold has done its job for me, I will shift out of gold into asset classes that people either hate or are as bored by as they are currently bored by gold. When gold has done its job for me as insurance, I will cash in the policy and move on as I would with any other insurance policy.
Well, thanks so much for your thoughts, Rick. I know you have a conference coming up this summer. You want to tell our viewers a little bit about it?
Daniela, I'm looking forward to seeing you at that conference. The Sprott Stansbury Conference takes place in Vancouver, British Columbia. This will be the 20th anniversary of that conference. It's in the third week of July. You can get information about the conference at Kitco or at our website, www.sprottglobal.com. We're highly excited about the conference. It will feature, in addition to many important newsletter editors, many mining company CEOs, people who have built their companies like Franco-Nevada, like Robert Friedland, like Eldorado Gold, like Silver Wheaton, the people who built the companies telling you how they built the companies and explaining why those lessons are important to you as an investor.
Thanks so much, Rick, and thanks for watching this edition of Kitco News. We'll see you tomorrow.